We're still right smack dab in the middle of earnings season over here. We have a lot of economic data coming out left and right, a lot of news headlines coming out left and right. But now we get to listen to the king of the stock market, Jerome Powell, come out and kind of give us some remarks in about an hour from now. So we're going to get the rate decision. Oh, YouTube, are you going to play around with us today? I don't see it coming through yet. Come on, YouTube. There we go. What's up, everybody? Welcome to FOMC Day. I hope you guys are ready. So we have TLT making some nice moves today, up about 1% so far. Again, that can all very, very easily and quickly change when Jerome Powell starts yapping. The Raytheon trade from this morning is looking pretty good. We got Ulta. I mean, looking good, man. You are actually, so this is one thing that I want to talk about with you guys too. Again, long time no see. Welcome back, everybody. Again, as you guys are filtering in here, make sure you guys are slapping that like on the way in. Again, we're live every single day, 9 a.m. You guys get 2 streams today. You got my back? What up, buddy? I got your back too. So Ulta's actually setting up, well, depending on, there's only one letter from FOMO. Ulta's actually setting up, so we played this on the weekly. So we got this weekly break to the upside here, but it's actually setting up another trade potentially on the daily. So if you see this day, 2 more days of consolidation here, you're actually going to get another little setup in here probably. I mean, again, we haven't even gotten through Powell yet, but that was something that I noticed. Kind of watching how this thing has been trading here. So broke above 500 on that one. It's been holding. Ideally, I want to see that thing at 518 for me to start taking profits on it, and then we'll see what happens. But Raytheon, it's a weird one. You kind of got to be a little bit antsy with it. Like, this is almost to the first TP there for Raytheon, the 1 to 9 risk to reward. That's kind of what I'm looking at there. TLT though, out of the grave here. So this is what we were saying though with TLT, that 93.50 area, that bounce off of there. That was kind of what we were expecting here. So guys, I hope you guys are ready. Welcome back, everybody, from the morning stream. We had a great morning so far. I mean, what did we do? Pretty much nothing. Please, I hope, for the love of God, nobody did anything stupid today trying to trade the nonsense that we were seeing. Like, what were we talking about this morning? There was really nothing gonna go on. Yeah, there was a sell-off. Cool, great. Whatever, man. Like, why are you trying to force trades? Please, I hope nobody did anything dumb trying to do stuff on FOMC Day. But any crazy news that we need to talk about that's come out in the meantime? I don't think so, but we can take a look. Let me see. Boeing is up over 6% today. What? 5.77 right now. That's pretty aggressive on Boeing. Yeah, any tickers you guys want to take a look out for? Oh, what up, buddy? What up, Chris? I remember you. Yeah, back in the game, back to the basis. Final month-end numbers later today. There we go, man. There we go. Welcome back, dude. Welcome back, everybody. Remember, we're live every single day. You took a nap? Nice. You went snorkeling? I love you guys. I love you guys taking that information and then being able to do whatever the hell you want. That's what I like to see. Let's see. Dude, I got that, like, club thing tomorrow, too. But, like, I don't know if I actually want to go. Like, I should go for being, like a, what do you call it? One of the top spenders. But, like, I just, like, I don't really want to go. I'm like Gatsby. I just don't show up to things. Let's see. What up, morning crew? What up, James? How you doing, buddy? So, yeah, I don't know what I'm going to do with that. I gotta go running today. I'm probably gonna have to get up and go to the bathroom at some point because I've just been sucking down water the entire time I've been sitting here. I mean, again, anything above 5, like this high here on Ulta of this day, that 511.50, 512 area, it's almost a straight shot to our 518. But again, it's gonna really depend on what Powell says. I would expect him to come out and be a little bit more dovish and hint at rate cuts in the future, but again, you never know. It's not his job and it's not his goal to even come out and surprise the market anyway, but you never know. We'll see what happens with it. It's going to be fun. We love listening to Powell, man. That's like my favorite thing to do. When Powell starts talking, that's when things start to get fun. So, yeah, that's kind of what we got here for kind of the updates on any of the swings that we had. Grab the Raytheon this morning. Want to see how this thing's going to work out. TLT, obviously, I'd love this thing back above 100. Using that 100 area as support is really what we want, but with the breakdown in yields that we've seen today, I'm a fan. So if you look at the 10-year over here and you throw this on the daily time frame, I mean, you could, all of those people that are like, ooh, bear flag, trend lines, I mean, they're playing this break to the downside here. So we basically, if you look at it, if you flip the kind of the perspective, we've been short yields here, like from up top here. We bottom ticked it. So we're just waiting for the full trade to start playing out. SMCI looking for highs. That's interesting. Let's actually take a look at that quick and throw TLT back on here. But, I mean, if SMCI is reaching there, how's AMD doing? Whoa, this thing's getting a little spicy. Up about 2% here, but that thing's a monster. How's AMD looking? It's coming back. It's coming back a little bit. Down, like, what, 2.5%? I was looking at the amount, like, the dollar amount that I was down in the after hours yesterday. I was just doing the calculation on how many dollars the stock dropped throughout the entire day yesterday, and I was like, well, not gonna look at the long term. Not looking. It's still great, but like, yeah, those are not the days that you look at it, guys. So GM, no, not qualifying for anything that we need here. SoFi, also no. So nothing on either of those. The SoFi trade, though, was dirty. That was one of the ones that we missed. Now that you guys all have access to both the day trading and swing trading courses, now we're cooking. Now we're cooking. You guys are talking about tickers. I love it. Like this one was dirty. How's Mara doing? I mean, after we just had our way with this thing from down here, I mean, yeah, no, I don't want any of this. I want this thing to just break completely back down, and then we can play around with it. Then we can play around again. The post-morning stream DM. Not yet. I'll have to take a look at that. And then, yeah, all of you guys that are already in the day trading course that don't have the code for the 60% off the swing trading course, I haven't seen or looked for any of those yet, but I'll get those to you guys. But let's see here, man. Where's Ulta? ES doing absolutely nothing going into Powell. I mean, we're already down, guys, 0.8% today. That's a bit ridiculous. Like, not ridiculous, but that's aggressive. That's a big move coming down. 40 points on ES there. That's big. ELF. I mean, their earnings are a bit close here. The 6th. Their earnings are a bit close for me to want to play around with it. It doesn't look terrible. It's just the earnings are... And it definitely has shown that it can move very aggressively in the past. So, I don't hate it. It's just too close to earnings for me. That's kind of... I mean, that's kind of the deal there. So, again, as you guys are filtered in here, if you guys wouldn't mind hitting that like button, you guys have been crushing it recently. Like, you guys have been really, really going for it on the streams. Thank you, guys. I appreciate you. Anything new on the... Yeah, nothing over here. Oh man, I really want to listen to this Powell video right now because I know it's like the fake AI one, but we're gonna not do that and have YouTube yell at us. Dude, Twitter is so much better now that you don't see all these people just saying super stupid things all the time about like just conspiracy theories about stocks. It's so much better. Like somebody just tweeted like, SPX to 5,000 is a human right, quote, Janet Yellen. Like, that's funny, man. The Goldman report on the call skew. Oh, is that what you're talking about for the 3 months out, like, cheap puts? Yeah, I'm not really, like, I could see why the puts are very cheap, but it's probably not something that I'll take a trade on. Like, hedging, sure, but, like, I would go for just weaker names individually and just be like, all right, well, I would trade that setup along with saying, all right, but then treat it as a hedge. Just like what we did with Tesla when our hedge went up 400%, and so did our longs like 2 weeks ago, 3 weeks ago. That was epic. Lizard? I'm not a lizard. I understand that I'm like calling and telling you guys when stocks are about to explode, every one of them before they do, but that doesn't mean that I'm a reptile, guys. We're just good at this. Like, I understand. The things that we teach, we're just good at it. MMTLP? No idea. No idea. Dude, I got a Diet Dr. Pepper, though. I'm thrilled. I love these things. Puts at 10-year low. I mean, it doesn't hurt to, like, it doesn't hurt. Like, if you're going to hedge it, but, like, the problem is hedging... hedging to me is like it's like a two-part process. Okay, Toothless? All right, guys. All right, so you're a squirrel. You play with nuts all day. All right? I fly and breathe fire. Don't play with me. Squirrel. It's orange. I don't know, Moto. I don't know what you got going on over there, but this is orange. What were we saying? You guys are sidetracking me. Oh, hedging. Hedging's like a two-part process for me, and we're gonna talk about this a lot more in the mastermind that we're gonna do. But it's one, you have to identify a stock that already looks like it could break down anyway, and then it's about the entry and position sizing. How do you think we got the Tesla one? Tesla already looked like it wanted to break to the downside. That's why that hedge was so filthy, because it was already looking to go. So if there was any weakness in the market, it was going to get killed. And then our other names that we trade that look great to the upside, well, I held those, and it was ready to... You were talking about... No, I wasn't. CSV admitted to be a flying lizard. All right. Oh, now I can fly? Wait, are dragons lizards? All right, guys, can we stay on topic for 10 seconds here? It's FOMC day. Before you know it, people are going to start saying that they're buying zero data expiration, deep out of the money calls on nonsense because some, like, stupid alert came through that, like, somebody's buying a bunch of them on some option scanner. Like, guys, come on. Let's be smart here. I gotta pull the Powell stream up. Do I use options to hedge? Yeah, like I use options to hedge options positions. But it's not like a I do it all the time type of thing. Like, I could hedge Powell here. I just don't really feel the need to because the risk that I have out in the market right now is smaller anyway. So, which is what we've been saying for the last 2 weeks. Like, I feel no need, especially with the performance that we've had with the swing list that we've been giving you guys for like the last 3 months. There's no need to go crazy during the Powell week. You just take a break and start taking setups that look good, but you don't need to over risk on them. You just continue trading and doing what you got to do. Dragons are the most powerful lizards? All right, man. Well, thanks for the compliment. I take back what I said about you playing with nuts all day. All right. Where's Raytheon? Chilling. You're in a negative 1 day to expiration option? Well, I didn't know we were bending time over here, ladies and gentlemen, but I guess that's what we're doing. You're buying deep out of the money 0 day expiration calls because you got to alert for someone buying everything. All right. All right, Moto. There you go, man. So we've got about 15 minutes here, guys, until we're going to be getting that initial rate decision, which is not going to be a real rate decision at all. How do you hedge other than buying puts? Well, you could buy calls to hedge if you're mainly geared towards the downside, but that's usually what we're doing. You can do all sorts of different things. Like, there's many different ways to hedge. Like, if we swaps, like, you could do all sorts of stuff. Would we? No, we would never do any of that. So let's see how the Raytheon does. Again, that's a tiny position. I just want it. It just looks great. And the risk to reward on it is insane, too. Like, if you look at this, it's just coming right into this gap, which I don't like gaps very much. I don't trade gaps or put much emphasis on them ever. But, like, where's the next level here that we would look for? I mean, the lowest one is up in here, 95. And what would the risk to reward to there be? Even that is a 1 to 7. So, at that point, go for it. Hey, our guy, what up, buddy? How you doing? Let's see here. This is going to be an interesting one, so we'll see what happens. But yeah. Hope you guys are having a great day, man. I mean, we've been crushing it. Remember, everybody, we are live every single day, Monday through Friday, 9 a.m. We've gotten a lot of messages that were like, oh my God, you're back. And it's like, bro, I've been back. We've been having fun. Lots of fun. Let's see here, and I know all you guys in the swing and day trading course have been having an amazing time too. Those messages that you guys are sending me, I'm posting some of them. I mean, they're just ridiculous. You guys are crushing it. I love to see that. Ulta, I'd love you to, I could make him free before Powell, but I'm not going to. Good to see you live streaming. Thank you, buddy. Hedging is SC. No, it's not. David, good afternoon, everybody. Good afternoon. Let's see. There's almost 100 of you guys in here too that haven't hit the like button yet. That is, you're disappointing your bloodline is what you're doing right now. Your ancestors would be disappointed in you. Nettie, good afternoon. All right. Yeah, all we really got to do now is wait that 15 minutes until we get that initial rate decision. We're going to get... Do we get an SEP this time? Summary of Economic Projections? I don't think we do. You were slacking? The sun hasn't been out for a while over there. May want to consider getting a heated lamp. Dude, the weather here is awful. We've been able to show the background like every single day for like the last 2 weeks. It's just been dark. Missed your face? Oh, thank you. Thank you. I missed you guys too. And then yeah, guys, quick announcement here. The courses, again, this is limited time, but they are still 50% off. Buy one, get one free to the 13 winning months in a row day trading mastery course strategy. That one is just ridiculously disgusting. And then you guys get the swing trading course too, which I also send you guys the list of tickers every single week. Like, you guys, I mean, the amount of, like, testimonials and the messages that you guys send me every single day, like, the money that you guys are making is absolutely ridiculous. Like, it's insane. Like, some dude was making $200,000 in a week on the AMD one, which was just filthy. So if you guys are interested in that, if you're struggling in the market and that's something you want to take advantage of, there is that 50% off deal right now. So there you guys go. The link, I just put it in the live chat, but it's also at the top as well. Another bank failure. They cut their dividend. The NYCB, I think it is. Yeah, this down what, 40 something percent, 37. Yeah, these guys got hammered today. Oh yeah, Gilbert, it's just that link right there. Again, you guys got that 50% off deal there. Those of you guys that have been in there with us, if you guys want to let them know, if you want any other like the testimonials, man, just go over to my Instagram. The pinned one of the pinned stories is just all the a bunch of the messages that people have been sending me about how much success they've been having. So there you guys go. But let's get back to Powell here. Yeah, this thing got nailed on the suspension of the dividend. Regulate my blood temperature. Guys, I'm not a lizard. Guys, I understand I've called out everything, but I'm not a lizard. It doesn't mean I'm a lizard person. I've shown you how I'm identifying the setups. And then the stocks just go nuts. Like, it doesn't mean that I'm a lizard person, okay? Jeez. Come on, man. There isn't some, scary, I'm not, a wizard or anything. Well, I do, no. Maybe I'm a wizard. Maybe not. What's ES doing? Just kind of hanging around. 11 minutes until FOMO. All right, guys. I got to run to the bathroom for 2 seconds. I've been drinking a lot of water. So give me 2 seconds. Again, team, make sure you guys are hitting that like button on the way in. We got 12 minutes until Powell. This is, before you know it, I'll be back. Just 2 seconds. Sorry. We're back with my ankle monitor. No. Have I seen the Dumb Money movie? No. Telly moving. Let's get Ulta back up here. Oops. Oh, shoot. Where was the entry on this? I think it's like this. I gotta go to the weekly. Yeah, that... no, it was a little lower than this. like right there. Cool. Lock that on there. So I'm definitely a lizard. I'm not a lizard, guys. Hey, SUV, what up, man? Japan, how you doing? Oh, I hope you guys are ready. Did I wash my hands? Yes, guys. Seeing his ankles is the only proof. You guys hit the ankle threshold like 2 days ago. Or a few days ago with the, whatchamacallit, the 100 like threshold. Now it's 500, though, since you hit it. So it is a Powell day. You guys might be able to do it this time. It's possible. It's possible, man. Just do Control Z. Yeah, you're right. I probably should have done that. But, you know, it's basically the same thing. It doesn't matter. The levels didn't change. It's 518 is still where I'm selling it. So it doesn't matter. SV doesn't own a sink. I actually have 2 sinks. Actually, I have 2. More than 1 sink. Also more than 0 sinks. Okay? So... All right, man. Dude, I love seeing all you guys in here, man. Let's do it. How about 250? 250 what? On what? All right, guys. 9 minutes. You guys excited? I'm excited, man. I'm excited for some Powell today. We got to get the stream up after we get that rate decision. See what happens. I mean, it's going to be fun. It's going to be fun as always. He's lying? I'm not lying. We did it. Oh, 250 likes? All right. All right, you drive a hard bargain. We'll do ankles at 250. So, guys, if that's what you want today, if you want me to be... we just talked about this earlier today. You guys can't treat me like a piece of meat. Watch, it's like I start, like, we go on like a 4-month tear of hitting like every single swing trade that there is in the market. You guys call me a lizard and try to treat me like a piece of meat. Like, whatever, bro. Like, it's fine. Whatever. Just go make your money, I guess. All right, man. You are getting another setup, though, on the daily on Ulta. Like, through the rest of the week, if this consolidates, like, you have another one. Which would be very interesting. Dance, monkey, dance? Stop. You're so rude to me. I'm a T-bone at least. Thanks, guys. Appreciate it. Appreciate it, guys. So, you people are just ridiculous. All right, man. Yeah, no day trades today. No point of doing that. If you did decide to day trade today, you need to introspectively think about what your goals are actually out of the market. Because you're not thinking long term. Like, people trying to trade today and like forcing trades and stuff, it's like your goals are just obviously not long term because you're going into an FOMC day. You know the morning is going to be a little bit weird. The logically speaking, it doesn't make any sense. Especially for what I teach you guys. Like, that would make no sense. What do we got here? What do we got here? Anything good? No. Nothing on the feed. Nothing on the news feed here. Lizards are considered a delicacy in many parts of the world. Yeah, and my Instagram DMs from, like, you dudes. Like, stop. It's okay. You guys can shoot your shot all you want. I'm just not gonna... it's not for me, man. I don't know what to tell you. The Telly is probably going to be the one thing I watch the most during Powell. Because if they come off as a little dovish, man, and these dum-dums start, like, repricing in March cuts, like, this thing is going to go. If everyone likes with all accounts, we only need 125 likes. Well, I don't think you guys are going to be able to do that. There's a reason casinos are so nice. Yep. Yeah. So, we'll see. We'll see. Dude, I love these Diet Dr. Peppers. They're, like, amazing. Not enough scales? No. Stop. I just read them and I'm like, what do you expect to get out of this? All right, man. 5 minutes to go. 5-minute countdown here, ladies and gentlemen. Here we go. Welcome to Powell Day, FOMC. This is the day that you guys have all been waiting for. You got to control your expectations, control your emotions, and make sure you don't do anything stupid. CMR! Welcome back, my man. Again, guys, all you guys in here right now, remember, we are live every day, Monday through Friday, 9 a.m. Like clockwork, every single day. We've been doing that for a little while, too. These Powell days are nice, though, because these streams get out to the people that, like, just, like, YouTube just, like, doesn't show it to them. Ralph, what up, buddy? How you doing? A lot of boring action here so far. This market's boring me. Ulta's just screwing around between, like, 504 and 508. The Feds are coming! They are. They are. Diet Dr. Pepper from the fountain, like the McDonald's one, I bet is really good. I was such a diet soda hater because, like, I had them when I was, like, a kid, and I was like, this is disgusting. It tasted like drinking straight aspartame. And then now I tried them again, and I was like, whoa, they changed the formula. You have 2 puts on GM, 4 calls on SoFi, 1 put on SoFi. Well, again, if you have a strategy that's been back tested and you know exactly what the expected results are over time, sure, do what you got to do. That's what we do. That's what is in all of the courses for you guys. All back tested, all like tested over time. That's why I can come out and just say, like, the day trading strategy that's in the day trading mastery course, 13 winning months in a row. And I go even further and just show you guys every single trade that was taken with it in 2023. It's nasty, man. Once you guys see it, you can't unsee it. The average risk to reward on them is like 1 to 6. Like, it's crazy. And then the swing trades, we just haven't been missing, really. Like, dude, there haven't been many misses. So, let's see. 3 minutes here, team. Here we go. And then the biggest part of the event today is in 30 minutes after that at 2:30. Every day for the rest of the year, then not every day, right? Yeah, that'll come to an end. You're watching Baba? Yeah. I just, like, Baba to me now is just, it's just continuing to show me that, like, I don't need to be any part of it. Like, there's nothing here right now. There's nothing here. Earnings coming up. Like, maybe you get the earnings flip. We can use one of the earnings strategies, the post-earnings strategies on it. But other than that, I'm just not too interested in it. Maybe long-term shares, but other than that, no. What do we want here? Raytheon. That's what we want. And then we got Telly over here. Ulta. And we're going to see what we get. We got 2 minutes here, team. Here we go. Here we go. Again, team, as you guys are filtering in here, make sure you guys are hitting that like button. Helps out a whole lot with the streams. The Q&A is so fun to watch. That's my favorite part of it. I don't even like this part of it is just like waiting for all the nonsense to happen. What do I think of Netflix? Let's see. That's actually setting up pretty good. I don't hate that. Dude, Netflix, how high did Netflix go? 580? Yeah, what did I make on those? Like, I made them free and then sold the rest of them for like 200-something% off of that. What do I drive? I used to have a Mercedes, but, like, I don't have a car anymore just because, like, I don't need one. Like, in Boston, I literally have needed a car a total of 0 times since I've lived here. So, like, I just don't have one. I don't have to go anywhere, like. Plus, like, I would get, like, a pretty sick car. I just, like, you can't drive them in Boston. The roads are bad. Like, I saw somebody outside my building the other day with a Huracan, and I was like, it's 30 degrees, 25 degrees out here, dude. What are you doing? Like, your car is going to get hurt. All right, what do we got here? 20 seconds. Potholes. You're by the ocean, the salt water. It's just not a recipe for success with nice cars. Carvana? I wouldn't hate that. I would not hate a Carvana trade. Didn't we do it recently, too? We nailed it on that, I think. I think that's in one of the big wins area on Instagram. When Pista? Probably when I go to Florida. I pay people to drive for me? Well, I do. That's called Uber, though. All right, ding, ding, ding. It's not market open, but it's the, oh, big candle. What's Telly doing? Selling. The spreads on the Ultas just went nuts. All right, I'm waiting for the news feed to come through just to kind of see what we get. Not great so far out of the market here. TLT, oof. Yeah, TLT got hit there. That's the initial reaction, though. We got to see where it actually wants to go. I haven't seen anything come through the feed yet. That was just like 2 p.m. sell. So let's see what we got here. Let's see. Big boy candles. Here we go. How are we not getting anything on the newsfeed yet? It's been a minute. This is strange. Here we go. Ooh, this is interesting. FOMC does not expect to reduce rates until it has greater confidence inflation is moving towards 2%. Here we go. FOMC judges risks to achieving employment inflation goals moving into better balance. Any adjustments to rates to be based on incoming data, evolving outlook, balance of risk. FOMC highly attentive to inflation risks as economic outlook is uncertain. Economic activity is expanding at a solid pace. Job gains have moderated since early 2023, but remain strong. None of those things right now could be considered dovish, like, at all. So that's what the market's reacting on so far here. Is that the same thing coming out of Fast Stock News? Why is this not adjusting? Let's see. Yeah, that's the same thing coming out. So big candle to the downside initially. Market's down about 52 points. 1% here. TLT's holding, though. Oh, yeah, they're not raising or cutting rates at this meeting. Yeah, okay, I thought that was just obvious to everybody that they were not going to do that. Yeah, they're not. There's no raise or cut or anything. So you're moving down to this BJ key level here. Let's see what we got. TLT is holding a little bit on this with the market just dying. We can throw this on the 15-minute. They're eating it back up. That's interesting. Ulta came down a little, but it's holding. But this thing gets delayed reaction, so watch out on that. Yeah, Ralph, I think you're right on that one. So now we got to look forward to, whatchamacallit, what Powell is actually going to say. Were they pricing in rate cuts? For January? No. It was like 99.99% probability that they were not going to do it at this meeting, and it actually makes 0 sense to do it at this meeting. March is the one that people are up in the air about, which I think is still a bit silly. For me right now, the way that I would describe it is 50% probability that they start cutting in May, 85% plus probability that they start in June. So by June, we should have, by the conclusion of the June meeting, we should have at least one rate cut. Because remember, and I think I've said this a lot, but those of you guys that are filtering back in here may not have heard this. This is important, ladies and gentlemen. So what a lot of people don't understand about the way this economic data is portrayed, or actually how it works and how rates affect things, is one, if you think about inflation, if CPI goes from 5% year over year to 3% year over year, that doesn't mean that prices are coming down. It just means that things are increasing, but at a slower rate. The same thing is true for the effect of high rates. So if you leave rates, and we use this example in the newsletter this weekend, it's like you're running on a treadmill. So if you're on a treadmill and you slowly start increasing the speed or the slope at which you're running at, well, eventually you're going to get tired faster, which in that example is basically prices coming down or inflation starting to come back to the downside. Now, if you start to slow down or decrease rates or slow the speed or the incline that you're running at, well, that doesn't mean that you're just going to suddenly get a giant boost of energy. You're just going to slow things down at a slower rate. So the effects of or the actual like inflation numbers are like they will continue to trend to the downside, but they're going to decrease slower. That's all that rate cuts at this point are going to do, especially the 25 basis point rate cuts that everybody's expecting. If they do jumbo ones, 50 to 75, which I don't think they're really going to do, then yeah, you'd see a little bit more of like a knee-jerk effect out of the market, but that's not what's happening. The other thing is the only two real arguments that I could see, which the 4 rate cuts in March are basically like earlier than May, is one, deflation. So if you have elements of all of these inflation like metrics that are less sticky than others and they're actually turning to the downside, you could have a little bit of deflation risk, meaning prices come down. You might think that's a good thing. It's really not. Very, very, very bad. And the other argument is like the $7.4 or $7.6 trillion of United States debt that needs to get refinanced this year. How do they refinance the debt? Well, they sell more bonds. Where are rates right now? Very elevated levels. So they would not want to refinance this debt and lock in long-term high rates so that our interest expense every single year as a country goes sky high. So there's pressure from Janet Yellen, which is what we've been talking about a lot, to start decreasing rates. So ES eating this up right now. This is basically a nothing burger right now. Guys, please do not do anything stupid. Please. At Powell Day, anything can happen. Anything can happen here, guys. So let's see what we got. We got about what, 24 minutes to go until the press conference here. So we're gonna pull this up. Yeah, we got it here. We got it up. So we'll be waiting for that. Again, team, if you guys wouldn't mind, as you guys are hopping in here, tapping that like button on the way in helps out a whole lot with the algorithms on YouTube here. Costs you nothing to do it. Also makes it way easier for you guys to find these streams. Again, because we're live every day, remember. Boom, boom, when Powell speaks, market down. Well, I mean, I don't know. Never know. Netflix holding here. Where's RTX? That thing's still all right. Ooh, here we go. Oh, wait, no, that was 5 minutes ago. That was 5 minutes ago on the news feed there. So I don't see anything new. So it's just those two, that statement that we read out before, the does not expect to reduce rates until it has greater confidence in inflation moving towards 2%, which if that actually doesn't make any sense. If the Fed has confidence in inflation moving towards 2%, it's almost too late, because the pace at which it's going to go to 2% is they're just going to put themselves behind the curve in terms of rate decreases, because inflation will most likely fall below 2% if they have confidence that it's actually going to get there, because it means that rates are like really at elevated levels, stifling all of this growth. Let's see. Billy, you're gonna have to ask them about that. I haven't been over there in like what, 4 months, man? 4 months? You gotta ask them about that. I got no idea. Did Powell talk already? No, it's at 2:30. 2:30. Ulta moving down. Let's see. Jose, thank you so much for the super, buddy. I appreciate it. What type of speech and what verbiage moves the market? From Powell? I mean, almost anything that he says, honestly. Like Powell could, like, any type of forward guidance that he starts to give with the, like, in terms of rates, and also what's the reasoning behind the move. Like right now, yeah, I almost like it. You don't have to send another super, Jose, but like, can you be more specific? It's like, what type of verbiage? It's like, well, there's a lot of different things that he could say that moves the market, but like pretty much anything that he says can move the market. If you're asking what the reason behind this move is right now, what the Fed said was they need to be more confident in inflation coming down to 2% before they consider decreasing rates. So if you think about what the market has actually been expecting, they've almost fully priced in that we're going to start cutting rates soon. Now, what Powell is coming out and saying is kind of hold your horses, guys. We're starting to get there, but we need more confidence. We need to be sure, which is not necessarily what the market really wants to hear. Now, the reason why you're not seeing like a drastic, crazy drop on this is because all of like the smart market participants already know that. They already know those things. So like, it's not like Powell says a specific word and then you buy or sell. You have to think more so about the big picture. So that's why it's a little bit of a harder thing to answer, because it's like, well, it depends on the environment. Like, I know you're asking for like broad so that you can take it into your own kind of learning. Like in this situation right now, if Powell were to say he's not considering decreasing rates, the market's going to tank. Like last time when he came out and said, well, we're probably at the peak, we're going to start considering decreases in interest rates, that's very dovish, like very dovish statements coming out of Powell that then tells the market, buy. So an increase in the rates makes the market go, no. Increase in rates makes the markets go down. Decrease in rates makes the markets go up. The reason why rate decreases increase like prices. Banks don't expect anything until later this year. That's incorrect. So if you think about decreasing rates, think about lending and borrowing. It makes it a lot easier for companies to get their hands on capital. The other thing it also does as well is that if you think about discounted cash flow models and the way a lot of people value companies, if the interest rate is higher, the discount rate is higher, you're going to discount those future cash flows and terminal value back to a lower present value if rates are higher. So when you increase rates, present values go lower. When you decrease rates, present values go higher. So it's really those two main things. TLT ate that up pretty nicely. Let's see. So it's not like a word that he says. Decreasing rates will signal the beginning of either a recession or a soft landing. Yep. Thanks for the knowledge, bro. I appreciate it. No problem, guys. No problem. We do this every day. Yeah, but Jose, if you have any more questions, man, just throw them in here. I got you, dude. Any questions that you guys have, I am always available. And that's the other thing, too. Once you guys hop into the, and you get the 50% discount deal on the courses, if you guys have any questions on anything, I'm always around Instagram or Twitter. Just DM me, and I'm always answering your guys' questions. I mean, there's not many of them. Usually they're quick questions because everything in there is like simple to understand. Thoughts on SPY? I don't care. It's Powell day. There's nothing to do in the market today, guys. Nothing. If you guys want to go watch somebody gamble on FOMC, go watch somebody else. That's not trading. That's gambling. We all have established our edge over here with the swings and the day trades, and we just implement that in the market. It's boring. It's easy. But that's why the strategy is 13 winning months in a row. Simple. Easy. So many of you guys approach the market like, I have to do something today, or I want to do something at this time, and it's like you have to turn that off, or you're going to fail. And those are the two options. It's like you may think that you can kind of counteract it, and it's like, how's your performance, though? That's the thing, and it's like, we're like, I want you guys having success, not screwing around trying to gamble. Chris, no. All right, let's see what we get here. Things are starting to pull back up a little. RTX did. Ulta did a little. Nothing crazy, though. Like, Billy, like, I don't understand why you would want to. I want you to think about the market like this. Think about what the successful, profitable, smart, savvy trader would do in times like this, and then do that. Or you can think about the opposite. We were talking about this earlier. Think about what the amateur, unprofitable person who will never make money in the market would do in a time like this. Okay, think of those actions that they would take, and then don't do any of them. Let's see. All right, we got 15 minutes. Ding, ding, ding. New candle. There we go. So I'll take that as a yes. No, I don't own any of those. Let's see. If you want to be consistent, don't gamble. Right, and don't do things like everybody else does. It's mind-boggling to me that people think that they're gonna be like, I'm gonna do everything that these people on Twitter say, and it's like, but I'm not having success, and it's like, yep, yeah, makes sense, man. Tally moving down. Let's see. Let's see, what do we got? That I don't have to re-gift these. I do not want your re-gifted pants, dude. I don't want that. That I don't want. Like at all. This market's interesting here. Yeah, I don't... You guys are so strange sometimes. Like, so strange. Oh my god. All right, 14 minutes to go until we can listen to Papa Powell talk. When Lambo, well, no, I know you make smart decisions, Ralph, but when you guys start making smart decisions, why do you think people call me a lizard? So I've handed you guys everything. Every single one of those, every single chart that's like popped off in the last like 3 months, I've given it to you guys like 2 weeks before it does. Now they call me a lizard. All right, I get it. Maybe I'll stop doing that. I'm just kidding. I'm not going to stop doing that. All you guys on the swing cards are still getting those lists. You talking about Netflix? Yeah, I don't hate it. The IV and the premiums are going to be ridiculous, but this needs like a week or two. Probably a week. You need a little bit more consolidation on here for me to be interested in this thing. RTX. What's that doing? Nothing. Chameleon. What up, buddy? Didn't want to gamble? Smart, Leo. Good for you, buddy. Because here's the thing. It's like, if you take a trade ever that is not following a back-tested, data-driven strategy, especially for, like, a short-term trade or a day, every single time that you enter a day trade, it should be based on, like, and we've gone over this so many times, but, like, it has to do with systematic versus discretionary trading. Like, most of you guys are trading with discretion, and that's why your performance is where it is. If you start trading systematically, which basically means, again, like it doesn't even have to be with my strategy. Like, the one that I give you is nasty. Like, the 13 winning months in a row, the thing is a money printer. All outlined, like, nasty. But, like, what you need to think about is, one, are there very, very specific rules? Is it back testable? And how easy is it for you to implement every single day? That's it. About Disney? What is that? That's funny. Nice. All right. 12 minutes to go until Papa Powell. This is going to be fun, man. This is going to be fun. Ulta holding on. RTX holding on. So these are all looking good so far. I don't think Powell's going to come out and just, like, capitulate everything. He could, but I don't think that's very likely. AMD CEO says planning for larger number in AI chip demand. Well, that's nice. That's nice. Ulta doing nothing. Lori, what up? How you doing? Let's see. Hope you guys are ready for Powell, man. We got 11 minutes. It's going to be fun. It is going to be fun, man. Oh, my God. You guys are almost at 100 likes already. Jeez. You guys might hit the 250 threshold today. Oh, God. We can't be doing this. We did ankles last week. We can't do it 2 times in a row. That's not okay. All right, let's see. Let's see here. Yeah, guys, remember, we are live too every single day, Monday through Friday, 9 a.m. So if you do enjoy these streams, make sure you guys are coming back. Miss you? Laurie, I'm here every day. You don't gotta miss me. I'm here every day. Let's see. That news is irrelevant. Let's see. Run it up or Mikey will find you. Bro, I don't know how much more we can run it up, man. Like, the past couple months, these swings and the day trades have been ridiculous. Like, it's just been Print City. Like, I'd have to go through and track, like, which trades, like, the win rate on the swings, and it's, like, definitely over 60%. And they've been hitting. So, we'll see what we can get. I like how ES is just, like, getting slapped at the lows, and then Ulta and RTX are just like, yeah, whatever. I love that. Those are nice signs of strength there if the market wants to come back up. But it's really going to depend on Powell, because if we get spillover into tomorrow, that relative strength is probably going to end. Enjoy. Still here every day. Yeah, well, I yell at you guys sometimes for doing stupid things. All right. I apologize, but I gotta go to the bathroom again. Dude, I've been drinking so much water with this 75 hard thing. I'll be right back. Give me like 2 seconds. I'll be right back, ladies and gentlemen. We got 9 minutes until Powell. Remember, we got that special deal going on, the 50% off on the on both the courses, the day and swing trading ones. The 13 winning months in a row day trading mastery course strategy, the swing trading course. Again, you guys can't go wrong with those. If you aren't having success in the market right now, that is where you need to be. So there's that link there. Give me like 2 seconds. I'll go to the bathroom. Keep smacking that like, and then we'll prepare for Papa Powell. Hi. So I'm not the only one. I'm a lizard. I'm not a lizard, dude. I'm not a lizard. Also, you can't turn the volume up because I mute the mic every time. RTX getting steam here. I like that. Raytheon. Anybody want to get mad at me for trading defense stocks? Going once. Going twice. Sold to the person who hates money in the back. All right, let's see. All right, guys, let's see. I was going to say. I mean, Telly above 96. I like that. Still green on the day. I got invited to some club event for lizard people. No, it's just for people who spend way too much money on nonsense, which is sometimes me. Who knows? I make my own money, so I spend it how I like. Just kidding. I don't do that anymore. I retired from that. Five likes away from 100 as well. Thank you, team. Cranking it. 7. All right, I got to get this stream up and running. For Papa. All right. My computer may hate me, but it'll be cool. Thank you for the info on the rates and market relationship. Yeah, no problem, Jose. I mean, we're going to have the mastermind coming up that we're going to do in March. Part of it is going to be obviously day and swing trading, everything that you guys would ever need to know about that. And then it's going to be very macro driven. So we're going to talk a lot about everything that you would need to know about macro long-term investing. So we're going to do DCFs, NPVs, reading balance sheets, cash flow statement, everything like that. And then also I'll give you guys basically the entire like college curriculum of like finance as well. that you guys will all receive as well. It's going to be like 8 to 10 weeks, 3 times a week. It's going to be like the most value-packed thing you guys will ever see. Yeah, and then everybody already in the courses is going to have first dibs on that and a discount. Lori 60? Lori, you're like the one person I won't call a boomer. Everybody else, you guys are boomers. If you're older than me, you're a boomer. Did I go to school for finance? Yeah, I did, but it was useless. But like, I know what you guys need to know. This for the course. The mastermind is going to be slightly separate, but if you've already taken either of the courses, you're going to get a discount and the and first access to the mastermind, because there's going to be like very limited spots. I'm only taking the people that like I know and like are willing to. Is it lifetime access to it? Yeah, you get lifetime access to it. You pay once. You get everything that I add to it. The swing course, you get the watch list every single week. And there's that 50% off deal on that one right now. They're buy one, get one free. That's probably going to end real soon, though. You guys are... when's the mastermind? It's going to be in March. We're going to do some more announcements on it next week, though. I'll give you guys a little sign-up thing for it. You're in both already? Then you guys are good to go. It's funny because the stuff you talk about is from your favorite and most dreaded finance class into college. It took me 3 times to pass, but the only class I remember and learned the most in. Yeah. Yeah, it gets fun. I mean, these RTXs are getting there. That's not bad off that entry. That's pretty good. Does it give access to my OnlyFans? Sure. Sure, if you really want it. Just kidding. I don't have an OnlyFans. How long is the mastermind going to be? It's going to be 8 to 10 weeks, 3 classes a week, probably an hour long each. So whatever that comes out to be, it's going to be long. And we're probably only going to have time to do one of them before I disappear forever. Let's see. We may be like boomers, but at least we don't whore ankles out for likes. If it ain't broke, don't fix it. Just kidding. Just kidding. All right, guys. 3 minutes to go. It's great to see all you guys back in here, man. Woo! I'm ready for Jerome. Bring him out. All right, what do we got here? Anything useful? Nah. RTX pop? Yeah, it did. Yeah, it is popping up there. I like that. He doesn't have OnlyFans. He's got Only Feet. I guess. Whatever you guys want to call it. Remember the time that Gabe said he was going to give like a free, like a discount or like a free membership for like the first person that created an OnlyFans for my ankles? That was so funny. There's like so many OnlyFans accounts out there of just pictures of my feet. Like, it's so stupid. Somebody's going to ask me one day, be like, what is this? Be like, dude, long story, man. I can't. It wasn't me. Yeah, I like the RTX there. Where's ES? Just bouncing off that BJ key level. Do I like Rumble stock? I mean, the setup there is interesting. It's whoa, that thing went. See, this is what I'm talking about with this thing. The reason I'm not going to trade it is exactly what the reason why I never took this setup but mapped it out for you guys and was like, hey, I'm not doing this. Why? Because of this nonsense. It's going to whip around way too much for me to feel comfortable taking a position. Like long-term shares, don't hate it. If you're going to think about trading it, would not be something that I would go near at all. Let's see. It will come back to haunt you when you run for president. Guys, you know all the crazy things that I've said on these live streams? They're all out there. There's no way that I could run for office. So, all right, guys. We are about to get Papa Powell here. Hope you guys are ready. 1 minute to go. 30 seconds here, man. So, there we go. I mean, I'll throw that link to the courses in there one last time for you guys just before we head into Powell. Again, that 50% off deal is not going to last for that much longer with the bundle. Yeah, there you guys go. You guys have seen all the success that people have been having with it. It's been ridiculous. But let's focus in on Powell. and get going here. Raytheon looking good though, man. Aerospace and defense. Am I buying any options? Nope. I'll tell you guys what I'm doing when the time comes. All right, here we go. Here we go, ladies and gentlemen. I'm looking at the podium. No Powell yet, but he's coming. He is coming. RTX is moving there. Call me Nikki Haley. Buying calls on defense. Sorry. Sorry. It was right there. It was a layup. I had to do it. All right, where's Jerome? Here he is.
We focus on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made good progress toward our dual mandate objectives. Inflation has eased from its highs without a significant increase in unemployment. That's very good news. But inflation is still too high, ongoing progress in bringing it down is not assured, and the path forward is uncertain. I want to assure the American people that we are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Over the past 2 years, we have significantly tightened the stance of monetary policy. Our strong actions have moved our policy rate well into restrictive territory, and we've been seeing the effects on economic activity and inflation. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. GDP growth in the fourth quarter of last year came in at 3.3%. For 2023 as a whole, GDP expanded at 3.1%, bolstered by strong consumer demand as well as improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have been weighing on business fixed investment. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 165,000 jobs per month, a pace that is well below that seen a year ago, but still strong. The unemployment rate remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up on balance over the past year, particularly for individuals aged 25 to 54 years, and immigration has returned to pre-pandemic levels. Nominal wage growth has been easing and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer run goal of 2%. Total PCE prices rose 2.6% over the 12 months ending in December. Excluding the volatile food and energy categories, core PCE prices rose 2.9%. The lower inflation readings over the second half of last year are welcome, but we will need to see continuing evidence to build confidence that inflation is moving down sustainably toward our goal. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Over the past 2 years, we have raised our policy rate by 5.25 percentage points, and we've decreased our securities holdings by more than $1.3 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. We believe that our policy rate is likely at its peak for this tightening cycle, and that, if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. The economic outlook is uncertain, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess the incoming data, the evolving outlook, and the balance of risks. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. We will continue to make our decisions meeting by meeting. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our questions.
Here we go.
From the New York Times. Thanks for taking our questions. Obviously, in the statement and just in your remarks there, you note that you don't want to cut interest rates without greater confidence that inflation is coming down fully. I wonder, what do you need to see at this point to gain that confidence? And as you make those decisions, how are you weighing recent strong growth in consumer spending data against the sort of solid inflation progress you've been seeing?
Sorry, say that last part again.
How are you weighing the growth data and consumption data, which have been surprisingly strong, against inflation data?
Okay, so what are we looking for to get greater confidence? Let me say that we have confidence. We're looking for greater confidence that inflation is moving sustainably down to 2%. Implicitly, we do have confidence and it has been increasing, but we want to get greater confidence. What do we want to see? We want to see more good data. It's not that we're looking for better data. We're looking at continuation of the good data that we've been seeing. And a good example is inflation. So we have 6 months of good inflation data. The question really is, that 6 months of good inflation data, is it sending us a true signal that we are in fact on a path, sustainable path down to 2% inflation? That's the question. And the answer will come from some more data that's also good data. It's not that the 6 month data isn't low enough. It is. It's just a question of, can we take that with confidence that we're moving sustainably down to 2%? That's really what we're thinking about. In terms of growth, we've had strong growth. I mean, if you take a step back, we've had strong growth, very strong growth last year, going right into the fourth quarter. And yet we've had a very strong labor market, and we've had inflation coming down. So I think, whereas a year ago we were thinking that we needed to see some softening in economic activity, that hasn't been the case. So I think we look at stronger growth. We don't look at it as a problem. I think at this point we want to see strong growth. We want to see a strong labor market. We're not looking for a weaker labor market. We're looking for inflation to continue to come down as it has been coming down for the last 6 months.
And I'm sorry if I could just follow up very quickly. When you say that you want to make sure that it's a true signal, is there anything that you're seeing in the data that makes you doubt that it's a true signal at this stage?
No, I think I would say it seems to be the likely case that we will achieve that confidence, but we have to achieve it, and we haven't yet. And so, I mean, it's a good story. We have 6 months of good inflation, but you can, and you know this, you can look behind those numbers and you can see that a lot of it's been coming from goods inflation, for example, and goods inflation running significantly negative. It's a reasonable assumption that over time, goods inflation will flatten out, probably approximate zero. That would mean the services sectors would have to contribute more. So, in other words, what we care about is the aggregate number, not so much the composition, but we just need to see more. That's where we are as a committee. We need to see more evidence that sort of confirms what we think we're seeing, and that tells us that we are on, gives us confidence that we're on a path to a sustainable path down to 2% inflation.
Nick Timmeros of the Wall Street Journal. Chair Powell, it seems to me you raised rates rapidly over the last 2 years for two reasons. One was the risk of a wage price spiral. Two, there were risks of inflation expectations becoming unanchored. This morning's ECI report for the fourth quarter shows private sector payroll growth running at a sub 4% pace. Inflation expectations are very close to where they were before the inflation emergency of the last 3 years. And given that you appear to have substantially cut off these two tail risks, and that you've judged here today current policy is well into restrictive territory, what good reason is there to keep policy rates above 5%? Are you really going to learn more waiting 6 weeks versus 3 months from now
exactly what we
that
said.
you have avoided those two risks?
So, as you know, almost every participant on the committee does believe that it will be appropriate to reduce rates. And for partly for the reasons that you say, you know, we feel like inflation is coming down, growth has been strong, the labor market is strong. What we're trying to do is identify a place where we're really confident about inflation getting back down to 2%, so that we can then begin the process of dialing back the restrictive level. So overall, I think people do believe, and as you know, the median participant wrote down 3 rate cuts this year. But I think to get to that place where we feel comfortable starting the process, we need some confirmation that inflation is in fact coming down sustainably to 2%.
If I could ask differently, if you hold rates high as inflation moderates, as it has been, target rates will exceed the prescriptions of the Taylor rule or experience. What would be the reasoning for holding rates higher than the levels recommended by those rules in the current instance?
Well, look, I think, as you know, we consult a range of Taylor rules and non-Taylor kind of rules. We consult them regularly. They're in our Teal book, and they're in all the materials that we look at. But, you know, I don't think we've ever been at a place where we were setting policy by them. And they're, depending on the rule, it will tell you different things. There are many different formulations. Another way to think about it is implicitly is so. In theory, of course, real rates go up if holding all else equal as inflation comes down. But that doesn't mean we can mechanically adjust policy as real rates, as inflation comes down. It doesn't mean that at all, because for one thing, we don't know. We look at more than just the Fed funds rate. We look at broadly financial conditions. But in addition, we don't know with great confidence where the neutral rate of interest is at any given time. But that also doesn't mean that we wait around for to see, the economy turn down, because that would be too late. So we're really in a risk management mode of managing the risk, as I mentioned in my opening remarks, managing the risk that we move too soon and move too late. And I think to move, which is where almost everyone on the committee is in favor of moving rates down this year. But the timing of that is going to be linked to our gaining confidence that inflation is on a sustainable path down to 2%.
Howard.
Hi, thanks, Chair Powell. I'd like you to key in on the use of the word in the statement that inflation still remains elevated. You've pledged to cut rates before inflation reached 2%. So that implies that there's some sort of intermediate step here on inflation, and that a cut would be consequent with a change in the statement language that inflation remains elevated. What's the step down from there?
Yeah, I don't know that we worked out the particular statement language and that kind of thing. I would just say, if you look at where 12-month inflation is, and it's still well above core is 2.9%, for example, 12 months, which is way down from where it was. Very, very positive development, very fast decline, and the case is likely that it will continue to come down. So that's where it is. But we're wanting to see more data.
So if I could follow up on that, the statement allows that you want greater confidence on inflation falling before you cut, but it doesn't mention the other side of the mandate, a slide in employment. Would a slide in employment also bring you to the point of cutting rates?
Yes. So let me say that we're not looking for that. It's not something we're looking for. But yes, if you think about, in the base case, the economy is performing well. The labor market remains strong. If we saw an unexpected weakening certainly in the labor market, that would certainly weigh on cutting sooner. Absolutely. And if we saw inflation being stickier or higher or those sorts of things would argue for moving later. In the base case, though, where the economy is healthy and we have ongoing growth, solid growth, we have a strong labor market, we have inflation coming down. That's what people are writing their SEP around. And in that case, what we're saying is, based on that, we think we can and should take advantage of that and be careful as we approach that question of when to begin to dial back restriction.
Claire Jones, Financial Times. Just to circle back to the greater confidence aspect of the statement, there's been a lot of unanimity in recent meetings. I'm just wondering, going forward, when it comes to all needing greater confidence, is the unanimity, or at least consensus among FOMC members, about what the threshold for that greater confidence is? And if not, could you maybe tell us a little bit about the discussion today on, what the variations between FOMC members was on what constitutes enough confidence to cut rates, and also if there was any variation on how quickly that greater confidence threshold could be reached? Thank you.
We're not really at that stage. There was no proposal to cut rates. Some people did talk about their view of the rate path. I would point you to the SEP as good evidence of where people are, although it is one cycle later. So, we're not at a place of really working out those kinds of details because we weren't actively considering moving the federal funds rate down. I will say there is a wide disparity, a healthy disparity of views, and you see that in public statements, in the minutes and the transcripts when they're released every 5 years. So we do have a healthy set of differences, and I think that's actually essential for making good policy. We're also able to reach agreement generally because we listen to each other, we compromise, and even though not everybody loves what we do, they're able to, for the most part, able to join in. To me, that's a well-functioning public institution.
Rachel. Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. So over the past few years, there have been all these real-time indicators that helped us gain a sharper understanding of where the economy was, like open table data or office attendance. You've talked about vacancies in the past. And I'm wondering at the start of this year, what might be on that dashboard for you that's giving you the clearest picture of the economy, including on rents, if you could touch on that. Including? Rent costs.
Yeah. Well, so we're not, it's not the pandemic, so we can actually rely on more traditional forms. People are working, they're getting wages, and the economy is largely reopened and is broadly normalizing, as you see. So I wouldn't say we're looking at that sort of more innovative data as much. You point to rents, so of course we follow the components of inflation very carefully, which would be goods inflation. I talked about that a little bit. You mentioned housing inflation, so the question is, when will these lower market rents find their way into measured rents as measured in PCE inflation? And we think that's coming. and we know it's coming. It's just a question of when and how big it'll be. So that's in everyone's forecast, I would say. So that will help. But at the same time, we think goods inflation will probably, it's been giving a lot of disinflation to the effort, and probably that declines over time. But it may well have some more time to run. You know, the supply chains are not perfectly back to where they were. In addition, it takes time for the healing process to get into prices. So there may be still a tailwind. We'll find out with that. So we look at the things that relate to our mandate very carefully, and as you would imagine.
I guess just as a quick follow-up, do you feel comfortable at this point saying the economy has reached a soft landing, or is that part of looking for more confidence?
No,
I wouldn't say we've achieved that, and I think we have a ways to go. Inflation is still, core inflation is still well above target on a 12-month basis. 12 months is our target. Certainly, I'm encouraged, and we're encouraged by the progress, but we're not declaring victory at all at this point. We think we have a ways to go.
Steve.
Thank you, Mr. Chairman. You've said that you would know the neutral rate by its works. So I'm wondering what you could tell me. How do you believe the neutral rate is working? We're telling you right now that growth is stronger. In other words, how much is the economy really being restrained right now by the current funds rate? And how much restraint does it really need additionally if inflation is still coming down?
So I think you do see in the interest-sensitive parts of the economy, you do see, for example, housing, you see the effects, you do. Your second question, though, really, I think is important, and that is a lot of this has come through, a lot of the disinflationary process has come through the healing of supply chains and also of the labor market. So you've seen that other set of factors is really different from other cycles and has brought that, working with tighter policy, which has enabled the supply side to recover, I think is that mixture has been behind what has enabled this. So no, we really do think that we're having an effect broadly across the economy. I would point to the interest-sensitive parts of the economy as well as spending generally. But it's a joint story. It's a complicated story.
But how much restraint are you actually imparting to the economy, would you say, relative to the neutral rate?
I think it's of course, you know that it's not something you can identify with any precision, but a standard approach would be to take the nominal rate, 5.3%, let's say, and subtract a sort of a forward measure of inflation. If you do that, and there are many, many ways to calculate the neutral rate, but that's one I like to do. And you're going to get to something that is materially above mainstream estimates of neutrality, of the neutral rate. You will, but at the same time, you look at the economy and you say, this is an economy that grew 3.1% last year. And you say, what does that tell you about the neutral rate? What's happening, though, is the supply side has been recovering in the middle of this. So that won't go on forever. So a lot of the growth we're seeing it isn't just a tug of war between interest rates and demand. You're getting, more activity because of labor market healing and supply chains healing. So I think the question is, when that peters out, I think the restriction will show up probably more sharply.
Thank you. Sorry. Thanks for taking the question, Mr. Chairman. You mentioned earlier we're not seeking a weaker labor market. I think you said. Can you talk a little bit more about that? Do you think the labor market now is back to quote unquote normal, and that we can achieve the inflation target without wage gains coming back down to what they were pre-pandemic? Even with today's ECI levels, they were still above those pre-pandemic levels.
I think the labor market, by many measures, is at or nearing normal, but not totally back to normal. And you pointed to one or more of them. So I think job openings are not quite back to where they were. Wage increases rather are not quite back to where they would need to be in the longer run. I would look at it this way, though. The economy is broadly normalizing, and so is the labor market. And that process will probably take some time. So wage setting is something that happens. It's probably will take a couple of years to get all the way back, and that's okay. That's okay. But we do see. You saw today's ECI reading. The evidence is that that wage increases are still at a healthy level, very healthy level, but they're gradually moving back to levels that would be more associated, given assumptions about productivity, are more typically associated with 2% inflation. It's an ongoing process, a healthy one, and you know, I think we're moving in the right direction.
So that process can continue without a weakening of the labor market, basically, you're saying?
Well, I think the labor market is, I don't know if it's rebalancing. Clearly, there was a fairly severe imbalance between demand for workers and supply at the beginning of the pandemic. So we lost several million workers at the beginning of the pandemic from people dropping out of the labor force. And then when the economy reopened, you remember 2021, you had a severe labor shortage, and it was everywhere. Panic on the part of businesses, couldn't find people. So what's happened is we expected the labor market to come back quickly, and it didn't. And 2022 was a disappointing year. And, you know, we were kind of thinking, well, maybe we won't get it back. And then 2023, we did, as you know. So labor force participation came back strongly in 23, and so did immigration. Immigration came to a halt during the pandemic. So those two forces have significantly lowered the temperature in the labor market to where it's still a very strong labor market. It's still a good labor market for wages and for finding a job, but it's getting back into balance. And that's what we want to see. And you know, one great way to look at that is what's happening with wage increases. And you see it now across the major things that we track. It isn't every quarter, but overall, there's a clear trend, still at high levels, but back down to what would be consistent with where we were before the pandemic and with 2% inflation.
Chris.
Hi, Chris Rugaber at Associated Press. Thank you. I wanted to follow up on Rich's question. It sounded like you suggested that you're not worried about faster growth so much. So wanted to see if you're seeing anything that suggests that inflation could reaccelerate from here. And it sounds like you're saying you're not worried that solid growth from here on out poses any risk to inflation. Thank you.
No, I think that is a risk, the risk that inflation would reaccelerate. I think the greater risk is that it would stabilize at a level meaningfully above 2%. That's to me more likely. Of course, if inflation were to surprise by moving back up, we would have to respond to that, and that would be a surprise at this point. But I have to tell you, that's why we keep our options open here, and why we're not rushing. So I think both of those are risks, but I think the more likely risk is the one that I mentioned, which is you've had 6 good months, very good months, but what's really going to shake out here? When we look back, what will we see? Will inflation have dipped and then come back up? Are the last 6 months flattered by factors that are one-off factors that won't repeat themselves? We don't think so. We don't. That's not what we think. But that's the question we are asking. We have to ask, and we want to get comfort on that.
And just one quick follow-up. Governor Waller had mentioned the revisions that are coming on February 9th for the CPI data. Is that something you're watching as well? And if we see those revisions fairly minor, is that going to give you more confidence where things are going?
We'll just have to see. Yeah, we'll look at those. Last year was a surprise.
Michael McKee, Bloomberg Radio and Television. If you don't want to use the term soft landing, would you say at least that from your point of view now, the other scenario of a hard landing caused by the Fed is off the table, or the risks have diminished very much? And you mentioned below 2% inflation on a 3-month basis. Core PCE has been running at 1.5%, and there are those on Wall Street who think that if you maintain the level of restriction you have right now, you could end up with inflation running below your target. How do you see that?
That's the deflation risk.
So your first question, how to describe where we are. So I guess I would just say this. Executive summary would be that growth is solid to strong over the course of last year. The labor market, 3.7% unemployment, indicates that the labor market is strong. We've had just about 2 years now of unemployment under 4%. That hasn't happened in 50 years, so it's a good labor market. And we've seen inflation come down. We've talked about that. So we've got 6 months of good inflation data and an expectation that there's more to come. So this is a good situation. Let's be honest. This is a good economy. But what's the outlook? That's looking in the review. The outlook, we do expect growth to moderate. Of course, we have expected it for some time, and it hasn't happened. But we do expect that it will moderate as supply chain and labor market normalization runs its course. The labor market is rebalancing, as I mentioned. Job creation has slowed. The base of job growth has narrowed. And of course, 12-month inflation is above target and getting down closer to target. It's not guaranteed, but we do seem to be getting on track for that. So those are the risks and questions we have to answer. But overall, this is a pretty good picture. It is a good picture. Your second question was, sorry.
Could you get inflation that is below target, end up with inflation below target, and you have to do something about that?
So the thing is, we're not looking for inflation to tap the 2% base once. We're looking for it to settle out over time at 2%. And the same thing is true. If we have a month or two of lower, and we have that now, of inflation that's annualized at a lower level, that wouldn't be good. We're not looking to have inflation anchor below 2%. We're looking to have it anchored at 2%. So if we do face those circumstances, then we'll have to deal with that. I think as of now, the question, which we want to take advantage of this situation and finish the job on inflation while keeping the labor market strong.
Edward.
Edward Lawrence from Fox Business. Thank you, Mr. Chairman, for taking this. So as I've heard from some district Fed presidents, is it, in your view, a little premature to think that rate cuts are right around the corner? And then when we do see that first rate cut, should we interpret that as the beginning of a rate cut cycle, or is it a one-off?
So I'll point you to that language on your first question. We included that language in the statement to signal clearly that with strong growth, strong labor market, inflation coming down, the committee intends to move carefully as we consider when to begin to dial back the restrictive stance that we have in place. So if you take that to the current context, we're going to be data dependent. We're going to be looking at this meeting by meeting. Based on the meeting today, I would tell you that I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that.
Thank you.
But that's to be seen. So I wouldn't call, when you ask me about in the near term, right, I'm hearing that as March. I would say I don't think it's probably not the most likely case or what we would call the base case. Then your second question is
is this the start of when we see a cut, is it the start of a cutting cycle, or could it just be a one-off?
That's going to depend on the data. The whole thing is this is going to depend on the data. We're going to be looking at the economic data as it affects the outlook and the balance of risks, and we're going to make our decisions based on that. And it could wind up, we'll have another SEP at the March meeting, and people will write down what they think. But in the end, it's really going to depend on how the economy evolves. We talked about there are risks that would cause us to go slower. For example, stronger inflation, more persistent inflation. There are risks that would cause us to, or if they happened, that would cause us to go faster and sooner, and that would be a weakening in the labor market, or for that matter, very, very persuasive lower inflation. Those are the kinds of things. So we're just going to be reacting to the data. That's really the only way we can do this.
Victoria.
Hi, Victoria Guido with Politico. Could you talk a little bit more about productivity growth? You've mentioned multiple times about, the level of wage growth that's consistent with 2% inflation. We've obviously seen, you were talking about ECI this morning, in which it's cooled a little bit. It's still sort of above what you wanted to see. Growth has been very strong. How much of those numbers do you attribute to productivity, and do you see that productivity as sort of just temporary because of the factors, the labor and supply chain factors you were talking about, or do you think that productivity growth will fade over time?
So this is a really interesting question, and I think my own view is, I think if you look back to the pandemic, you saw a spike in productivity as workers were laid off and activity didn't decline as fast. And then you saw a deep trough of productivity. And then over the last, you saw high productivity last year in 23. I think we're basically in the throes of getting through the pandemic economy, and the question will be, what is it that has changed? The productivity tends to be based on fundamental aspects of our economy. Is there a case? Will it be the case that we come out of this more productive, more on a sustained basis? And I don't know. What would it take? It would take, people talk about AI, but my guess is that we may shake out and be back where we were, because I'm not sure I see work from home doesn't seem like it's a big productivity increaser. AI, artificial intelligence, generative may be, but probably not in the short run. Probably maybe in the longer run. So I'm not seeing why it would. But right now, I would say the productivity is kind of what falls out of the broader forces that are driving people in and out of the labor force, and activity returning and supply chains getting fixed.
Right, so would that be behind why we've seen such strong growth, but we've also seen inflation fall, that maybe there's just a higher level of productivity?
That's
right
one
now?
way to look at it, yeah.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. I want to ask a little bit more about housing. I'm wondering, how closely are you watching rent and housing prices as you evaluate whether and when to cut rates? And it seems like housing prices are not coming down as quickly as you expected.
So when we think about, our statutory goals are maximum employment and price stability, and that's what we're targeting. We're not targeting housing price inflation, the cost of housing, or any of those things. Those are very important things for people's lives, but they're not, those are not the things we're targeting. We're also well aware that when we cut rates at the beginning of the pandemic, for example, the housing industry was helped more than any other industry. And when we raise rates, the housing industry can be hurt because it's a very interest-sensitive sector. On top of that, we have longer run problems with the availability of housing. We have a built-up set of cities, and people are moving further and further out. So there hasn't been enough housing built, and these are not things that we have any tools to address. But where it comes into play very specifically in our work is inflation, which is a combination. It's really rental inflation. You're taking owner's equivalent rent and then actual rent paid by tenants, and you're running that through the CPI calculation or the PCE calculation, the one we look at. And what that's telling you is that market rents are increasing at a much lower rate, or even being flat, and that will show up in inflation over time. It has to, as long as that remains the case. So.
And just real quick, what is your response to the letter that was sent to you by some members of Congress asking the Fed to lower interest rates to make housing more affordable?
My response is what I started with, which is that our job, the job Congress has given us, is price stability and maximum employment. Price stability is absolutely essential for people's lives, most importantly not most importantly, but mostly for people at the lower end of the income spectrum who are living at the edges, at the margins. And so for someone like that, high inflation, in the necessities of life, right away you're in trouble. Whereas even middle class people have some scope to absorb higher costs. So we have to it's our job. It's what society's asked us to do, is to get inflation down. And the tools that we use to do it are interest rates. So that's how we think about that.
Courtney.
Courtney Brown from Axios. Can you give us some insight into whether the committee discussed the possibility of slowing balance sheet runoff in the months ahead?
Yes. So I would start by saying that balance sheet runoff so far has gone very well. And as the process has continued, we're getting to that time where questions are beginning to come into greater focus about the pace of runoff and all that. So at this meeting, we did have some discussion of the balance sheet, and we're planning to begin in-depth discussions of balance sheet issues at our next meeting in March. So those questions are all coming into scope now, and we're focusing on them, but we're at the beginning of that process, I would say.
Quick follow-up. Is it the case that the Fed would decide to lower rates and make adjustments to the balance sheet runoff in tandem?
Yes, we do. We see those as independent tools, and so they don't. For example, if you're normalizing policy, you might be reducing rates but continuing to run off the balance sheet. In both cases, that's normalization. But from a strict monetary policy standpoint, you could say we're loosening and one with tightening. So that could happen. It's not something we're planning or thinking about, but right now we're thinking about getting to a place where we're going to see the balance sheet run off to continue. We're watching it carefully, and as I said, we'll be looking into that as a committee starting in March.
Thanks.
Simon Urbanovich with The Economist. Thank you, Chair Powell. You've mentioned 6 good months of inflation data, but that not being enough to build up confidence. Based on your previous response that your base case is you probably wouldn't start easing yet in March, the implication is that 8 good months might not be enough either. Roughly how many months do you think you might need of good inflation data to be confident?
Yeah, I'm not in a position to put a number on it. I'm just going to say, it's not that we don't have any confidence. We have growing confidence, but not to the point where we feel like it's a highly consequential decision to start the process of dialing back on restriction, and we want to get that right. And we feel like the strong economy, strong labor market, inflation coming down, it gives us the ability to do that. We think that's the best way we can serve the public, because ultimately we've made a lot of progress on inflation. We just want to make sure that we do get the job done in a sustainable way. That's how we're thinking about it. In terms of when that'll be, that'll all come out of our communications, and we won't keep that a secret.
Hi, Chair Powell. Evan Reiser with M&I Market News. Can you explain a little bit more on what you're considering when tapering QT? Do you need to see the overnight reverse repo facility all the way down to 0, or is it something that you can start with a couple $100 billion there?
Not a decision that we've made, but I wouldn't think we wouldn't be taking a position that it's got to go to 0. I mean, if it were to stabilize at a different level, but that's not a decision that we've made. That's what we'll be talking about at the March meeting. A whole range of issues will be briefed up, and the committee will get into all of the issues that will be arising over the course of the next, let's say, year or so.
Greg.
Thanks, Greg Robb from Market Watch. Chair Powell, I want to change gears a little bit. In the presidential primary campaign that's been going on for the last 9 months or so, your name has come up often, and many Republican candidates have said that they probably wouldn't want to give you a 3rd term. So I wanted to give you a chance to talk about that. Do you want another term? You've had on the Fed. What's your stance on that?
I don't have a stance on that. It's not something I'm focused on. Focused on doing our jobs. This year is going to be a highly consequential year for the Fed and for monetary policy, and we're all of us very buckled down, focused on doing our jobs.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. As you mentioned, core PCE has been running at 1.9% over the past 6 months, and you guys are actually expecting core inflation higher this year at 2.4% compared to that 6-month measure. Given that forecast and that the median is for 3 rate cuts this year, what happens if inflation stays where it's been over the last 6 months for the next 6 months?
So we'll update our inflation forecasts at the next meeting. You referred to the December meeting. That's 3 months old, so it might be lower now given the data we've gotten. So look, as I mentioned, we're going to be reacting to the data. If we get very strong inflation data and it kicks back up, then we'll go slower or later or both. If we got really good inflation data soon, that would matter for both that would tell us that we could go sooner and perhaps go faster. So we're just going to be but of course we'll weigh that with all the other factors. We're setting policy based on the totality of the data.
But just to follow, if inflation stays where it is currently, that would probably mean that the real interest rate becomes more restrictive. Would that mean you'd have to trim more, perhaps, than you already have factored in?
Well, I think if we came to the view that that inflation that the 6-month inflation numbers, which are very close to 2, were in PCE world, if we came to if we thought that is really where we're going to be, then yes, our policy would be in a different place. It would. But that's the whole point, is we're trying to get comfortable and gain confidence that is where that inflation is on a sustainable path down to 2% or toward 2%.
Daniel.
Hi, Chair Powell. Daniel Davis, Agence France Presse. I just wondered if I could get your comment on the recent consumer confidence data. It seems to suggest that consumers are sort of moving towards a much more optimistic view of the economy. I just wonder, is it fair to say that they're moving towards where the Fed appears to have been in recent months? And do you think that inflation and falling inflation perhaps has played a role in that? And what challenges do you see going forward? Thank you.
Yeah, so it's been interesting that confidence surveys have been weak at a time when unemployment has been low, very low, historically low for a couple of years, but nonetheless that's been the case, and we've asked ourselves why that is, and one obvious answer, we don't pretend to have perfect wisdom on this, but one obvious answer is that the price level is high. So prices went up much more than 2% per year for a couple of years, and people are going to the store and they're paying much more for the basics of life than they were 2 years ago, 3 years ago, and they're not happy about it. And it's fine that inflation's coming down, but the prices they're paying are still high. So that is what that has to be some part of why people are unhappy, and they're right to be unhappy. This is why we need to keep price stability. It's why we need to do our jobs, is so that people don't have to deal with things like this. In terms of you're right. In recent surveys, you've seen a couple of significant increases in consumer confidence or happiness with the economy. I guess that's a good thing. That can support spending, can support economic activity. There's some evidence of that. But it is a fact that we have seen a meaningful increase. I think levels of confidence are still maybe not as high as they've been at various times, but they certainly have come up.
Thank you for taking our questions. Brian Menacino in business. Committee members have said they'd like to meet with business leaders and stakeholders in person to learn more about the economy in real time, given that some data are subject to large revisions, the issue of seasonal adjustments being thrown off balance, and many readings of the economy being quarterly. So did any members say they've learned anything not yet reflected in the data, or have you yourself learned anything through anecdotal evidence that hasn't been captured in the data yet?
Well, yes. I'm a big believer that yes. So we do meet with outside groups who come from all different parts of the economy, and I always feel like I spent most of my life in the private sector looking at individual management teams, and then building out from that. And so starting with GDP data and working into what's actually affecting people's lives is challenging. It's very hard. So I really like anecdotal data. In addition, as you know, the 12 reserve banks have really the best network of anyone. That in all their districts, they're talking to, not just the business community, but the educational, medical, all nonprofit community. They have arms into all of that. And so when they come back, that's what goes into the beige book. But they come back, and what each reserve bank president does is, during the Outlook go-around, they'll say, in my district, and they'll talk about 100 conversations. They won't talk up. They will give you input based on 100 conversations that they've had with people of all different walks. And I personally find it very helpful in understanding what's going on. And also, I think you hear things before they show up in the data sometimes.
Did any of them notice slowing economy based on what they've heard from their district?
Yes, I mean, if you look back at the last, not this beige book, but the one before, there was a lot of slower activity. I think that what you're hearing now is things are picking up a bit. You're hearing not in every district, and not every person that we talk to, but you're overall, it feels like you're hearing things picking up at the margin. So that's what comes through.
Let's go to Jeff Cox for the last question.
Thank you, sir. Jeff Cox from CNBC.com. Just kind of looking to put it all together. You talked about basically the economy looking strong with 3.3% annualized growth in the fourth quarter. Does the strength of the economy speak more loudly to you now than any inflation threat might? That you're in a position, in other words, to keep rates elevated as long as the economy stays strong, and you're more tilted towards that. And then also, perhaps, are you worried at all that the economy is maybe a little too strong right now, and that inflation could come back at some point?
I'm not so worried about that. It's again, we've had inflation come down without a slow economy and without important increases in unemployment, and there's no reason why we should want to get in the way of that process if it's going to continue. So I think declining inflation, continued declines in inflation, are really the main thing we're looking at. Of course, we want the labor market to remain strong too. We don't have a growth mandate. We've got a maximum employment mandate and a price stability mandate, and those are the two things we look at. Growth only matters to the extent it influences our achievement of those two mandates. Thank you very much.
All right, ladies and gentlemen, that is it for Powell there. Very interesting, man. So, I mean, he's kind of leaning more towards on the higher for longer side. The only thing we have to think about now is if the market actually believes him, because again, there is still that whatchamacallit, that hovering cloud over everybody. That's the what do you call it? The debt rollover. And no, guys, I told you, I'm not trading this. It's stupid to trade Powell. It's like very stupid. No, not doing anything. I'm just looking at positions, seeing if I can like enter anything, or seeing how, not enter anything, but like seeing what I would like to enter if the market wants to turn around. So, all right, team, that is probably going to wrap it up for us today. Again, remember, we're live every single day, 9 a.m. Eastern. So if you guys want to come back, tomorrow is going to be a really, really, really fun day. And then Friday is going to be wild with NFP. And then, oh, nice little bounce there. So, and then last little announcement, guys, that, that 50% off deal for the two courses that I have for you guys that are absolutely going to change the way that you look at markets and trading for the better there. I'll throw that link in here for you guys. Again, that deal's not going to be around forever, that buy one, get one free deal, the 50% off. So if you guys are struggling now, you need that final boost to get you to where you want to be in the market. Those are for you, man. I mean, the 13 winning months in a row day trading strategy, can't go wrong with that. The swing trading course, dude. I mean, the results that I've seen from you guys are insane. But let's see, TLT still up about 0.5%. We got Raytheon still looking all right. We got Ulta screwing around today a little bit, which is fine. I mean, this is setting ourselves up for another potential move up on the daily if this thing can consolidate. But overall, market not having any fun today. Down 1.3% right now. Looking to bounce out of this BJ key level here. What is it? About 38 minutes left in the market here. Nothing good. What's NFP? Non-farm payroll. So that's going to be happening on Friday morning. So, team, make sure you guys are hitting that like button on the way out. I will see you bright and early tomorrow at 9:30 a.m., which is not that early, but for some of you guys, it might be, depending on where you live. Very interesting day here. I'm very interested to see if the market calls BS on some of the things that Powell said. The questions were all right. I mean, there were some really stupid questions in there, like especially from a reporter to say like, "Oh, did we reach the soft landing yet?" And it's like, what? We haven't even started attempting a soft landing yet. So, some interesting statements, interesting comments there, but that's really all we got here, man. And yeah, guys, once you guys are hopped into the courses, you guys have any questions about anything, just shoot me a message on Instagram or Twitter, and I'll help you guys out with any questions that you have. So team, I will see you tomorrow. Peace.